Today, we're going to talk about a book that's been the secret weapon for some of the world's most successful investors for like over 70 years. And it's so much more than a finance book. It's really a masterclass in psychology, in discipline, and in just plain wisdom. This is the core philosophy of The Intelligent Investor. So you think that being a literal genius would automatically make you a great investor, right? I mean, it seems obvious, but, well, history has a pretty stunning story to tell that proves that idea is just completely wrong. So let me ask you a question. What on earth could one of the greatest minds in all of human history have in common with someone today who's just, gambling on stocks on their phone? The answer is kind of humbling for anyone out there who thinks they're just too smart to lose money. The genius I'm talking about was Sir Isaac Newton. Yep, that Isaac Newton. Apples, gravity, the whole deal. Back in 1720, he got sucked into the massive hype around a company called the South Sea Company. It was basically the meme stock of its day. He invested, made a really nice profit, and he got out. Smart, right? But then he got a serious case of FOMO. He just couldn't stand watching other people keep getting rich, so he jumped back in at a much, much higher price, and he lost absolutely everything. And this is what Newton himself said about the whole disaster. He basically admitted that his incredible intellect was completely useless against the pure emotion of a speculative frenzy. I mean, think about that. He could understand the entire universe, but he couldn't control the madness of the crowd. And we're not talking about a small loss here. We're talking 20,000 pounds. That was an absolute fortune back then. In today's money, it's well over $3 million. A complete and total financial catastrophe for one of the smartest people to ever live. So, if a mind like Newton's can get crushed by market madness, what hope do the rest of us have? Well, that is where our guide comes in. The man who literally wrote the rulebook for how to navigate all this craziness, Benjamin Graham. This is the book, The Intelligent Investor. It first came out way back in 1949, and it basically created the whole concept we now call value investing. And its ideas are just as powerful today as they were then, maybe even more so. And hey, don't just take my word for it. You've probably heard of Warren Buffett. He was actually a student of Graham's, and he calls this book, quote, by far the best book about investing ever written. I mean, that's not just a casual compliment. That is a massive stamp of approval. And here's the key. Graham gives us the answer to the whole Isaac Newton puzzle. He argued that being a truly successful investor has almost nothing to do with how high your IQ is. It really comes down to your emotional discipline, your patience, having the right framework. It's about your character way more than your brain power. Okay, this brings us to what might be the most critical idea in the entire book. Graham starts everything by drawing a very bright, very clear line in the sand, a distinction he thought was the most important one you could ever make. See, for Graham, the word investment wasn't some casual term. It had a very strict three-part definition. Number one, you have to do thorough analysis. Number two, your main goal has to be the safety of principal. That means not losing your money. And number three, you should be aiming for an adequate, not an insane, return. And if what you're doing doesn't meet all three of those criteria, it's not investing. It's speculation. Period. End of story. So you have to ask yourself, which one are you? The investor looks at a stock and sees a piece of a real business. They ask, what is this company actually worth? The speculator, they just see a ticker price and they ask, is this price going to go up? It's a totally different mindset. And Graham was super clear about this. There's nothing illegal or even immoral about speculating, if that's what you want to do. But the minute you start tricking yourself into thinking you're investing when you're really just speculating, that's when you're in serious danger. You start taking huge gambles without even knowing it. And why is that so dangerous? Well, it gets us right to the psychological core of this whole philosophy. Because once you get that the real risk isn't just a bad stock, but a bad mindset, you realize the biggest threat isn't a market crash. No, it's something much, much closer to home. First, there's the hype. You know that feeling, that intoxicating buzz when a market's roaring, and it makes you feel like a genius just because you bought something that's going up. And then, on the flip side, there's the panic. That horrible gut punch of fear when prices are dropping, and it makes you sell at the absolute worst possible time, locking in a permanent loss. And what's behind both of those feelings? It's the crowd.
It's that powerful, primal urge to just do what everyone else is doing, which means buying at the top and selling at the bottom, exactly what Sir Isaac Newton did 300 years ago.
And here it is, Graham's most profound insight. The biggest problem you'll ever face as an investor, your worst enemy, is you.
So when you boil it all down, this is the big takeaway. You cannot control what your investments do. You will never be able to. The only thing you can control is how you behave. And mastering your own behavior, that's the real game.
Okay, so if we're our own worst enemy, how in the world do we protect ourselves from ourselves? How do we build a defense against that madness of the people that wiped out a genius like Isaac Newton? Well, Graham gives us a simple, incredibly powerful tool. He called it his ultimate weapon. It's called the margin of safety. Just think of it like a shock absorber you build into your whole investment process. At its heart, it's all about one simple rule. Don't overpay. No matter how amazing a company seems, you never, ever overpay. This becomes your shield against everything, a crazy market, your own mistakes, and your own emotions. So here's how it works. First, you do the work. You figure out what a business is actually worth, its intrinsic value. Then, and this is the critical step, you refuse to buy it unless the price is significantly lower than that value. That gap, that discount between the price you pay and the value you get, that is your margin of safety. That's your room for error. Which really brings us to the final big question you have to ask yourself. When you make a financial decision, who is actually in charge? Is it the manic up and down mood of the market, or is it your own calm, disciplined, rational analysis? Graham's life's work teaches us that only one of those paths is the one that leads to becoming a truly intelligent investor.